You're either going to see things go a bit weaker as the net takeaway over the course of the next several quarters, or we're going to find ourselves in a situation where we realize that 5.5% as the upper bound for the Fed funds is not as restrictive as the Fed believed it was in 2023. Yeah. What I worry about, however, is that if we continue to get inflation prints at these levels, the Fed is going to find itself backed into a corner where they need to cause a recession if they're going to hold that 2% inflation target.
So it's, Francis, I think from a past discussion, I got the sense that you guys are very more conservative than maybe the consensus on this economy. I took the recession talk off the table a year ago. Was that a little premature?
No, it would have been the right call because, yes, we do believe there is downward surprises for growth ahead, but they're not quite here yet. And this is what the Fed has to contend with. I'm with Ian on this one, is in the near term, inflation, we think, is going to continue to surprise to the upside, and the Fed won't be able to cut. They're going to lose the data support to cut in the near term. However, that increases the probability of a recession. And I remember members of my team back in December said, the Fed has pivoted early. This is going to provide indirect easing. We should lower our probability of recession calls for 2024. But now that we're back in an environment where we're losing those embedded rate cuts, we actually have to increase the chance of something bad happening here. I think the Fed is going to be in a situation with inflation data like this, PPI numbers, claims numbers, where they have to stay higher for longer. And they may have to stay higher until something breaks. That's the problem. Now, meanwhile, we're talking about PPI data, but yesterday we had the Bank of Canada. This morning we have the ECB. They're all saying we have the data to begin cutting. I think in the next couple of months, we might not be talking about recessions, but we'll be talking about how U.S. exceptionalism, which was once a good thing, is going to become more problematic for the Fed versus these other central banks and economies.
Right. Well, let me ask you this. What is the data that you're going to be looking at over the next several days and weeks, and kind of get a sense of what the Fed's going to be looking at? What are you going to be looking at?
We're looking at the job market because the focus has turned back towards inflation, which is not providing enough cover for cuts in the near term, probably not for June, although I'm already getting messages from my team here that the contributions from PPI that help us understand what PCE will look like are actually looking fairly light. So the Fed's PCE number might not be as severe as yesterday's CBI. But we're still worried about that labor market. Rehiring activity is down, layoffs are up, people are not as confident about their job prospects. And some of these leading indicators inside job reports, even though we look at the headlines like full-time employment down year over year, these are all really problematic. Labor markets don't break in straight lines. They break in nonlinear fashion. So while the market is focused on some of these inflation dynamics, our eyes are going to be on when does labor really start to break? Because when it breaks, it won't matter whether you're a CEO, won't matter whether you were in the inflation higher for longer. The Fed will have to refocus towards the growth side of their mandate.
Francis, why isn't labor broken yet?
Because we're in a major structural shortage. And that is changing the way that labor markets operate. It's changing preferences around labor markets. And we had an incredibly overheated labor market. So the lag is still in place. But let's remember, Tom, the average time from the first rate hike to its impact on the economy is 2 years. We're not past that window. We're entering it.